As of lately, a lot of REITs have found momentum again, and Stag is no exception here. And the thing that most people like about Stag Industrial stock is the fact that they pay a dividend every single month. Dividend yield is at 3.7%, which is pretty nice. And they have been growing this dividend for 11 years in a row. Year to date, this stock is kinda flat, but when we take a closer look, we see that Stag Industrial hit $34 in May. So the question is today's price still justified or is this monthly dividend stock overvalued? On the 30th of July, Stag Industrial presented earnings, where they beat on FFO and revenue. Taking a closer look at the earnings report, we see that revenue increased about 11%, which is very nice. However, total expenses increased 15%, driven by the loss on impairment. Adding the other income and expenses, we see that net income in fact increased 16% year over year. So margins are increasing here. Net income per share is also increasing year over year and is reported at $0.33. Looking at the most important number, the FFO, we see that this is also increasing pretty steady at 9%. The FFO per share is reported at $0.61, showing that dividends are covered pretty good, since the dividends paid are per quarter $0.36. Stag Industrial has 573 buildings in their portfolio across 41 states, totaling 114 million square feet. The occupancy rate is reported at 97%, which is a pretty insane number. I prefer 95% or higher for this type of company. The WALT is reported at 4.3 years, which is quite low in my opinion. I prefer 10 years or higher. The last important number, the net debt to EBITDA, is reported at 5, which is again a pretty low number. Nothing that worries me a lot, but I prefer 5.5 to 6.5 here. Diving into the lease expiration per year, we see that between 2025 and 2027, around 45% of the leases expire. Probably they are going to renew a lot of them, but it is something to keep your eye on. Looking at the specific tenants, we see that Stag Industrial has a great diversification, with Amazon being their biggest tenant at only 2.8%. The top 10 tenants are reported at only 10%, so to me this looks really good. The biggest industry is air freight and logistics, sitting a little under 12%. So again, this diversification also looks really good to me. For the full year guidance of 2024, we see that core FFO is expected to be in a range of $2.36 to $2.4, in line with the previous guidance. It's the same for the expected acquisition volume. The same store cash NOI change is expected to be a little higher, and retention is expected to be at the high end of the previous range. Everything else looks pretty good to me. Down the line, pretty decent earnings. Let's take a look at the fundamentals to learn more about the current situation. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Stag is a 7.2 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 16.3, indicating they are fairly valued. Later in this video I'll be showing my 3 price targets for Stag Industrial stock. So make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 740 million, and in this graph we see that revenue went up really steady over the years. For a REIT, this is looking really impressive. Margins are quite the roller coaster. but the long-term trend is upwards. However, the net margin is down ever since 2023. Earlier in this video, we saw that this number is increasing again. So that's the good part here. EPS is going up in the long run. It's not always steady and consistent, but that's very common for REITs. Analysis expect that in 2024 EPS will decrease, which is really sad to see. But in 2025 it is expected to see a 10% increase again. And from there they expect 15% growth in 2026. So this looks pretty interesting. For the revenue, it is looking pretty interesting as well, with 7 to 16% growth over the years, of which the highest growth is expected in 2026 and 2027. Return on assets is sitting at 3%, which is a low number even for a REIT. Return on equity is looking pretty decent, and the most important number, return on invested capital, is sitting at 2.5%, which is again a low number. But it is slightly higher versus the 5-year average, so that's the silver lining here. Current ratio is at 1.6, which is a decent number. Nothing really special to mention here. Right now, Stag has 2.8 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Stag has 87 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. Most recently, it is stabilizing a little bit. And when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at almost 3.7%, which is a great number. Annual payout is at $1.48 and payout ratio is at 62%, which is below the 75% average for REITs. And keep in mind, Stag pays a monthly dividend. They have increased the dividends for 11 years in a row, which is really impressive. The 5-year growth rate is a little shy to say the least. And here we see the dividends paid since 2015. They increased the dividends at a low rate. However, in the long run, this really adds up. In 2014, they paid an annual dividend of $1.29, and 10 years later, they pay an annual dividend of $1.48. In this graph, we see the expected dividends in 2024, 2025, and 2026. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase slowly from here. And overall, these dividends look really interesting to me. But how about the historical returns? I decided to compare Stag Industrial stock with the overall market. In this case, the S&P 500. Next to that, I added FR and EGP. On the 5-year chart, we see that Stag Industrial underperformed the S&P 500 with a big difference. Stag returned 66%, while the S&P 500 is sitting at 103%. And keep in mind this is including dividends. FR had a 62% return and EGP returned 68%. On the 1-year chart it looks pretty interesting, with the S&P 500 beating all 3 REITs in this list. However, Stag Industrial managed to get the highest return versus the other 2 REITs. On the 6-month chart, it is a close call, but FR is the winner here. It's interesting to see the momentum of all the REITs. On the 1-month chart, Stag has the lowest return, which is quite interesting. EGP had the highest return here with 3.5%. Bottom line, Stag underperformed the S&P 500 long term and short term. So, could this be the perfect time to buy Stag Industrial stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. Starting off with revenue growth. For the revenue growth, I'm filling in 5, 7 and 9%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm filling in 26, 27 and 28%. And for the free cash flow margin, I'm putting in 50, 52 and 54. For the PE ratio, I'm putting in 20. For the price of free cash flow, I'm putting in 17, 18 and 19. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Stag Industrial stock is a little under $40. I hit analyze, and we see one green number. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $30. We have a mid price target of $38, and we have a high price target of $47. To me, the mid to high price target is the most justified here, indicating that this stock could be undervalued right now. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on Stag is that I really love the company. It's one of my smaller REITs positions, but I can't wait to expand my position. Most fundamentals look pretty good and they have been performing quite steady and consistent. From a dividend point of view, things also look really good. They pay a monthly dividend, which is always an interesting thing, but above all, it is really safe and consistent. From a value point of view, I finally might get excited again. The stock has increased a decent amount in the past few months, and I made the decision to increase my position again and do this in small amounts, so I can get the best price possible, hopefully. I expect the stock to go down a little more in the coming periods with everything that is going on right now. And to me, the price is really good right now already. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.